detailed statement in this regard is available on Jubilant Foodworks' Q4 and FY21 results release and earnings presentation, both of which are available on the company's website under the Investor Relations section. With that, I would like to invite Mr. Hari Bhatia to share his views with you. Thank you, and over to you, sir.
Thank you. A very good evening to everyone. I hope you and your loved ones are continuing to stay safe and healthy. The external environment in Q4, for the most part, saw a sustained improvement over the previous quarter. After Q3 FY21, we had recovered 100% of our previous year's revenue. Q4 FY21 saw a healthy return to growth. This was driven by strong growth in delivery and takeaway channels, though the dining channel still trailed the pre-COVID levels. Continuing our focus on aggressive store expansion, we opened 53 new stores during the quarter. This included opening 50 new stores of Domino's. As a result, we opened a total of 134 new Domino's stores in FY21 against our initial plan of 100. We also opened 4 new stores in our international markets, which is 3 in Sri Lanka and 1 in Bangladesh. During the quarter, we announced an investment in DP Eurasia through the acquisition of our wholly owned subsidiary, Jubilant Foodworks Netherlands BV of Fides Food Systems Cooperative for approximately British pound of 24.8 million. Fides is the beneficial owner of 32.81% of equity in DP Eurasia, one of the largest Domino's franchisees, which is a category leader in Turkey and a strong challenger in Russia. With this investment, the company intends to try and replicate its best practices in the new geographies of Turkey, Russia, Azerbaijan, and Georgia through active board participation. The company also acquired exclusive master franchise rights to operate and sub-license the iconic Popeyes brand in India and the neighboring countries. Popeyes will be an exciting addition to the company's portfolio of brands and is expected to become one of the key drivers of growth for us in the coming years. As the quarter was coming to a close, as you know, the country saw a sudden surge in COVID cases from the second half of March. The company and the group mounted a series of initiatives to support our employees and their families through this unprecedented crisis. A cross-functional task force was prepared across the group that extended medical and other assistance 24/7 to all those who were in need. We set up several COVID isolation centers across the country and also established oxygen concentrator banks in key towns. Swift action in arranging for hospital beds and oxygen helped save many lives. We also rolled out a set of ex gratia benevolence benefits for the families of employees that we lost to the pandemic. This included up to 2 years of salaries as a payout, continued medical cover for the families, and support to the children's education. We also mounted a massive vaccination drive for our employees and their dependent family members in partnership with leading hospitals. More than 14,500 employees have been vaccinated with the first dose already. More than 480 store teams across 50 towns have been 100% vaccinated with the first dose, thus ensuring enhanced safety for themselves, their families, and of course, our customers. As the COVID caseloads increased significantly in April and May, various state governments started responding by localized lockdowns and allied restrictions. However, despite the reduction in operating hours and the impact of restrictions in dining, as you must have seen, our sales recovery in Domino's in April and May was strong, led by delivery in growth. So, and of course, we expect June to be better. Finally, before I end, I must say that we have been truly inspired by the way our team members have, despite all the challenges, managed to keep the business going through the pandemic and continue to serve our customers and our communities. They have truly done us proud. With this, I would now request our CEO, Pratik Pota, to continue this discussion by sharing his perspectives.
Thank you, Mr. Bhatia. Good evening to all of you joining us today. I hope and pray that all of you and your families have been safe through these really trying times. I'm pleased to report on our performance for Q4FY21, wherein we continue to improve sequentially and deliver the growth over the previous year. Revenue from operations was at rupees 10259 million, a growth of 14.3%. Domino's delivered a 14.8% sales growth during the quarter, backed by continued growth momentum in delivery and takeaway channels, which grew by 28.7% and 76.9% respectively. Dine-in recovery improved sequentially over the previous quarter, but was still significantly lower versus the previous year at 64.4%. EBITDA at rupees 2492 million grew by 47%, and EBITDA margin at 24.3% increased by 542 basis points year on year. Profit after tax at rupees 1043 million grew by 396%, and profit margin at 10.2% was up 782 basis points year on year. The company had liquid funds equivalent to rupees 6024 million by the end of Q4 FY21 in the form of cash and cash equivalents, bank deposits, and investments. I will now share some of the highlights of the last quarter. We opened 50 new Domino's stores consecutively for the second quarter and added 8 new cities, taking the city count to 293. As a result, we entered FY22 with a larger and more optimized store network than when we started last year. We saw a strong recovery in the delivery and takeaway channels. Within delivery, our own assets grew significantly faster than aggregators. Delivery growth was strong across all town classes, with the smaller towns growing faster than the tier 1 towns. Investments in digital and technology remain central to our strategy, and during the quarter, we introduced a machine learning-based model of personalized ranking to substantially enhance the pre-order experience. A host of other improvements during the quarter were made to our digital assets to further minimize time taken to order, enhance user experience, reduce friction, and target higher conversions. Our app installs were 6.1 million last quarter. Our international business saw a strong performance, with both countries being EBITDA positive last quarter. Having turned the business around in Sri Lanka, we opened 3 new stores in the country and have now equaled our earlier high number of stores in the country at 26. We rolled out an updated set of digital assets, including the app, in Sri Lanka that is already leading to an increased conversion and a significantly higher online ordering contribution to delivery sales. We opened 1 new store in Bangladesh. We remain very positive on the opportunity for profitable growth and network expansion in both these markets. We opened 1 store each for Hong's Kitchen and Ekdum during the quarter. These were both small delivery carry-out focused stores. We were pleased to see the Hong's Kitchen orders grow at a healthy pace in quarter 4 and revenues return to pre-COVID levels. It was still early days. and we were focused on refining our product, pricing, and overall proposition based on customer feedback, as also on strengthening our store-level operating processes and workflows. We remain committed to scaling up both these brands in a calibrated manner. We announced two significant investments during the quarter. DP Eurasia is a large Domino's business in Turkey and Russia, and our investment and consequent board presence will allow us to transfer our learnings and share our best practices to these markets. We also signed an agreement with Restaurant Brands International for the master franchise rights of Popeyes for India, Bangladesh, Bhutan, and Nepal. The chicken category is underpenetrated, and we believe that Popeyes will create excitement and help drive market expansion. As the company continues to grow and expand both organically and inorganically, we are building organizational bandwidth and capacity to drive these aggressive growth objectives. Towards that, we have created a new role of Chief Business Officer for Domino's India. This role will have end-to-end responsibility for Domino's in India, from strategy to execution. I'm delighted to announce that Mr. Rajneet Kohli, the erstwhile head of operations, has moved into this new role as President and Chief Business Officer for Domino's India. Rajneet's replacement as head of operations for Domino's has also been promoted and selected internally. Mr. Amit Maheshwari takes charge as operations head for Domino's India. We have also promoted Mr. Avinash Kant Kumar as the President of the Integrated Supply Chain Network for JFL. We are fortunate to have an extremely capable talent pool that is the right combination of organic talent groomed from within and top talent onboarded from outside. I'm happy to announce another such addition to our leadership team. Please join me in welcoming our new CFO, Ashish Goenka, who has replaced Mr. Prakash Bish. Ashish comes to us with a rich experience and proven track record from Hindustan Unilever and Airtel. We're also pleased to welcome Mr. Gaurav Pandey as the new business head for Popeyes. Gaurav has come to us from HUL, where he spent more than 16 years, and Gaurav has already begun building a strong team for Popeyes in India. While we are pleased with the performance of last quarter, what has given us even more energy and inspiration is the manner in which our employees came together. The manner in which our employees came together in response to the savage second wave of COVID. Teams of volunteers worked 24/7, selflessly and tirelessly in providing help to employees and families in need, and to them, we owe a huge debt of gratitude. As Mr. Bhatia said earlier, we have initiated a pan-India company-funded vaccination drive for all our employees and the dependents, and happy with the progress made so far. Owing to the second wave and the localized restrictions that were imposed, operating hours reduced considerably in the months of April and May. Despite that very challenging operating environment, the system sales recovery for Domino's in April and May was 94.4% and 87.7% respectively, when compared to the respective months of FY20. The strong delivery recovery helped mitigate a large part of dine-in and takeaway downside. Dine-in was shut pretty much in the month of May. In summary, we are happy with our all-round performance in Q4 FY21. We look forward to driving an even stronger performance and aggressive growth in the quarters and the year ahead. With that, I would like to call upon the moderator to initiate the question and answer session.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. I would also like to remind participants to please limit your question to two per participant only. You may come back in the question queue if you have any follow-up questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Yeah, thanks for the opportunity and congrats on numbers and the acquisition. My first question is on the recent data leak which happened. So you are an expert in delivery and OLO has been increasing. So my question is, was there any temporary impact of this in terms of apps getting deleted or customers getting a bit wary on ordering online? And any learning from this, why this has happened? Because 18 crore orders were available on the web in terms of number, address, previous orders and all that. So clearly that was a big breach. So any learnings on how this can be prevented and what's the way forward?
No, thank you, Abneesh, for the question. And I hope you've been well. I think the data breach incident that happened to us in the month of March, wherein a hacker attacked one of our servers and was able to extract data. I think we moved quickly to contain the attack, contain the breach, and avoid the spread. And therefore, we were able to prevent any operational impact on the business, nor was any customer's PII compromised. We moved immediately to have a global forensic agency onboarded very quickly, and they did a deep dive to identify possible causes and also recommend mitigation and strengthening plans. We also moved very quickly to file a complaint with CERT and also with the cybercrime cell. When the data leak happened, we also got an injunction from the Delhi High Court to ensure that ISPs blocked the URL where this data had been posted. We are also working, Abneesh, with leading security firms from across the world to do a complete scan and a comprehensive assessment of a security environment, also that of our partners. And we will be implementing world-class security solutions and systems. And more importantly, we'll be ensuring that we stay updated through a benchmarking periodically. And like I said earlier, there was no impact on our business or on operations, either during the period of the data leak nor subsequently. We haven't seen any impact in terms of either app deletions or customers moving away from delivery. And as you saw in the month of April and May, we have seen, if anything, improved delivery growth led by online. But you can be sure that this is a moment of learning for us. We have not taken this lightly, and we will be ensuring that we implement the most rigorous security systems to prevent from recurring ever in the future.
Sure, thanks. That's helpful. My last question is on DP Eurasia. So we have not seen many Indian consumer companies build scalable, large, successful businesses in Turkey and Russia. So what was the thought process here? Second, what happens to the balance stake? You have bought around 33% stake. And any key learnings or any key success practices which you have already identified which can be taken there?
No, thank you, Abneesh. I think we talked about this in our media communication as well, the rationale for our investment in DP Eurasia. And Mr. Bhatia spoke about it in his opening remarks as well. DP Eurasia is one of the largest master franchisees of Domino's Pizza globally. They have a very strong leadership business in Turkey and an exciting challenger brand position in Russia. On account of the 32.8% investment that we made in DP Eurasia, we have 3 board seats in the company. We have been using and we intend to use our board presence to offer our insights, to offer our learnings, and to share our best practices from India with them. We'll, of course, use the opportunity to learn from them in turn and bring some of those learnings into the Indian market. So, it's a very exciting business. They, of course, are independent listed companies, so I would invite you to look at their published results, to look at their performance. But we're happy with our stake in DP Eurasia and no plans to increase it further as of now.
just one follow-up here. So are there synergy benefits in terms of sourcing any meaningful opportunity available in those?
Abhishek, it's still early days yet. Like I said, we have a board position. We do not get involved in operations. So it's early to comment on whether there are any operating synergies as of now. But in case there are, of course, we will look at leveraging those.
Okay, that's all from me. Thanks. All the
Thank you, Abhishek.
Thank you. The next question is from the line of Manoj Menon from ICICI Securities. Please go ahead. Mr. Menon, you may please go ahead.
Manoj, you may be on mute.
Mr. Manoj Menon, if you have muted your line, can you please unmute it? As there's no response. Mr. Menon, are you able to hear us?
Yes, loud and clear.
Go ahead, sir.
Oh, thank you. Sorry for the trouble. When I was not muted, I don't know what's the problem with the line. Thanks, guys. Great performance in times like this. I got just two questions, not necessarily related to the current, business environment or anything of that sort. One, Prateek, just wanted your, longer-term perspectives on the relevance of Popeye brand for India. While I completely get the chicken opportunity, but when I look at the global experience as well, is that what Popeye is known for? Just wanted to hear from your thoughts, because in my understanding, it is the brand stands for multiple things and not necessarily just chicken. Correct me if I'm wrong. So I'm just maybe speaking as a consumer. So that's one. What's the longer-term realistic opportunity for a brand which is just a few thousand outlets globally? So that's one in India. The second, there are some, chatter concerns at a global level on the gig work, the employee policies, etc., which happened about 6 months back, which had a certain ESG, connotation to it. And it had definitely affected some of the European companies and some of the global, companies. There are two ways of looking at it. One, when I look at Jubilant, given the fact that, most of the employees are on your rolls, it may not be necessarily applicable for you. But just wanted to get your thoughts on, both these aspects, at 20,000 feet view currently. Thanks.
No, thank you, Manoj. Thank you for your question. And let me answer the first one to begin with on Popeyes. I think the way to look at the Popeyes opportunity is to size and look at the chicken opportunity in the country. So within the Western QSR market, chicken is one of the largest segments after the pizza category. Chicken is more than a 4,000 crore segment in India, and it's been growing very, very strongly. And if you look at the last 7-8 years, it's had a strong double-digit CAGR, more like 17-18%. And we believe, looking at all the consumer data points, that there is even now a significant opportunity to grow the category much faster and to much larger size. Given that India is a largely non-veg market, and poultry contributes to 2/3 of the meat consumption in the country. Despite that, actually the per capita consumption in India of poultry is far lower than even peer markets like Indonesia or like Thailand or any other market in the neighborhood. So that's the market opportunity. Now coming to your question on Popeyes. Popeyes is a brand that is focused on chicken, and the last couple of years has disrupted the chicken segment in the US on account of its successful innovation and very, very standout digital marketing. The chicken sandwich that they launched took up the entire category and established Popeyes actually as a thought leader in the market. I believe that our partnership with Popeyes will help us build a large, profitable and a vibrant business both in India and South Asia. And of course, we believe, and Mr. Bharti also said in his remarks, will become a very important engine of growth for us in the future. Yeah, so that's your first question, Manoj. The second question on the gig work and what are the implications for us as JFL? I think two or three things. First of all, like you rightly said, a dominant part of our workforce are people who are on our rolls, who are we converted them from being fixed full-time or part-time to being completely variable last year, as you're aware. So a bulk of our workforce, a large majority, dominant majority, is our own employees, and therefore this doesn't apply to us. But that said, I think using a gig talent pool remains an option for anybody whose business model is variable, whose revenue model is variable. It also serves to cater to an employee cohort, to a talent cohort who prefers to be on gig. So that remains an opportunity for us to evaluate and leverage. Without, and as you're aware, the new proposed labor code that's being in circulation also proposes some fallback and some social security for gig workforce as well. So I think there is a middle ground here where we can potentially work with gig workforce and do it in a way that's sustainable and that's win-win.
Understood. Prateek, just a next observation or just quick follow-up, if I may, on the second aspect was, what we wrote today morning as well, that, in our food tech report was, look, the new labor codes, codes are more conducive for the gig work. In India, honestly, given the, what the riders earn much more than their Western counterparts, etc., probably they're much more satisfied. So I don't think there is an issue in India per se. But the only context was, maybe there is an ESG angle there which you may want to take it back to, the management board, etc., to just look at it, from a medium-term point of view. And the second aspect also, here is that maybe this is a competitive advantage. That was my observation there, because given that you're probably only the only large player who actually employ, most of your, riders on your rolls. But at the same time, just one comment from your side is that I do remember in June last year, you actually variabilizing some of your costs. So that is the only reason I asked that. Is there any implication for you? Because, is there a thought process to, let's say, move away from the current equilibrium? That's all I just wanted to know.
No, thank you, Manoj. Thank you for leaving the thought with us. Just the one response that I would like to give on your comment about, our workforce. And you're absolutely right. The fact that we have a strong operations talent pool in our stores who are our employees and who've grown with us over the years, that's a big source of strength for us. And we do not intend to dilute that in any way. So even as we have moved fixed to a variable model, we have ensured that we've increased, if anything, our systems for engaging our employees, ensuring that we're able to groom our talent from stores. So our riders who intend to build a longer career with us, we groom them, we get them inside the store, we train them on our store processes, on the make line, and they grow to be shift managers and store managers and further on. So that's a big talent pool for us, and that's a big source of growth for us, for our talent. And we intend to make sure we strengthen that. There is no way we're going to compromise on that. So you're absolutely right. There's a big source of advantage for us. We're cognizant of it, and we'll be doing whatever we can to strengthen that, even as we drive efficiencies in the way we manage our workforce.
Got it. Thanks, guys. I have a couple of more questions. I'll come back into queue. Good luck.
Thank you, Manoj.
Thank you. Before we take the next question, I'd like to remind participants to please limit your question to 2 per participant only. The next question is from the line of Vivek Maheshwari from Jefferies. Please go ahead. Mr. Vivek, please go ahead with your question. As there's no response from the current participant, we take the next question.
Okay. Just one question for the moderator, one input for the moderator. You may want to have somebody check the line, because Manoj also had a problem earlier. You just want to check. I hope there's nothing wrong with the line.
So the line is unmuted from our end.
Okay.
The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, good evening, team. Congrats on a good set of numbers. I actually will restrict my question only to one, because it's a rather voluminous one and it has a couple of 2-3 subparts. So the question is mainly about the store opening opportunity. You have mentioned in the past that Domino's has a 3,000 total store kind of opportunity, so basically almost or a little more than doubling from the current level. But if you could just break that down into a little bit of granularity, especially how many stores you plan to open in FY22, and also this total 3,000 store opportunity, approximately over what time period do you think you can realize that? That is part one. Part two is on Bangladesh. We've been having an opportunity to open stores here since many years, but we are really subscale here. It's like 15% of India's population, so it's a huge opportunity. So what really stops us from opening many more stores in this geography? That is the second part. And third part, for Ekdam, see, kebabs and biryanis is a very, very sort of well-known, well-established model as far as the industry is concerned. Unlike QSR type of Chinese, which you are doing in Hongs, and therefore there is some experimentation with the business model you have to do. With Ekdam, there are other players who have already discovered and established a business model, and you just have to more or less roll out stores there. So, any reason why we cannot go very aggressive in Ekdam and open sort of significantly large number of stores, or at least open a cloud kitchen, so that we can serve at least a significant large population of urban India through Ekdam in the next 5 years. So these are the three sub questions that I have on the store opening opportunity.
No, thank you. Let me start by responding to the first one on the Domino's store opportunity. We are very excited with the potential for Domino's in India. We believe that there is significant room for us to grow Domino's stores in existing markets, metros such as Mumbai, Bangalore, Delhi, etc. In the tier 2 towns and small towns where we have one store or we have two stores. We also have a clear opportunity for expansion into new markets. We entered 8 markets, such markets last year. And we believe that there is a room for us to enter many, many more towns. There's also room for us to expand our network in channels, in educational campuses, travel and transport, etc. And therefore, the runway that we see for Domino's in the country is very, very strong. And we intend to therefore grow our network aggressively over the next few years. I think it will be difficult for us to give a prognosis about the number of stores for this year, because while we have the intent of rapid expansion, we also are cognizant of the constraints that we see on the ground right now, and that we've experienced in the months of April and May. And therefore, given the uncertainty around COVID, we're not putting a number out right now, but it would be fair to say that we'll be opening at least as many stores as we opened last year in FY22. We'll obviously try and open more. So that's on Domino's in India. On Bangladesh, we recognize that we have an exciting opportunity that lies ahead of us. It's a large market, like you said, where we believe the pizza category is underpenetrated. There's room for us to grow the category, both in terms of getting new users and also driving frequency. It's a category also where the digital ecosystem is just growing right now. It's young and it's growing, and we've got in on the ground floor on that. So we absolutely intend to open more stores in Bangladesh. Unfortunately, in the last 15 months, as you're aware, I think the expansion has been sort of stymied by COVID. But once that abates, we will go on rapid expansion in Bangladesh as well. And on Ekdam, I think that we are absolutely aware of the fact that the biryani segment, biryanis, etc. segment is a large segment. It's growing rapidly, and it's a market where we believe we have a right to succeed. So we will be expanding the network for Ekdam accordingly. Remember that Ekdam is just about 6 months old in the country, just under 6 months actually, of which about 4 months were impacted by COVID, if not all. And therefore, we have to ensure that when we make haste after taking into account all the learning and resolving the model completely, and making sure that we have the proposition right, the economics right, so we can scale up quickly. You're aware from our Domino's experience that we can, when we need to expand, we can grow rapidly, which we will do. We'll do that in a calibrated way, and we will do that keeping in mind the learnings that we've distilled many years ago from the Dunkin' expansion.
Okay, understood. My question on Ekdam was just because you mentioned in your opening comments as well that it's going to be a calibrated expansion. So it seemed to me that, it might get stretched over a longer period of time versus experimenting for 1 or 2 years, getting the business model right, and then really exploding the number of stores. So it seems to be the former rather than the latter from your commentary.
Sure. Appreciate. No, thank you. Thank you for your question.
Okay. Thank you.
Thank you. Reminder to the participants, please limit your question to 2 per participants only. The next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Yeah, hi, everyone. Thanks for the opportunity. 2 questions from my side. First is if you could share, your store expansion or your business model for Popeyes. Any targets in mind for next 3-5 years that you could share, because you talked about you are setting up a strong team there. The second question is on the margin outlook. If you could give us some thoughts on how are you seeing movement on the raw material side. Delivery charges will come in the base from June onwards. Do you see potential for margins for the core Domino's business to move up from current levels? That's all. Thank you.
No, thank you, Latika. Thank you for your questions. And so let me answer your Popeyes question to begin with. In addition to what I said earlier about Popeyes being potentially a very strong brand and a big driver of growth for us in a category that's growing rapidly and that has a long runway to grow. I think also what makes the chicken segment interesting is the fact that it also allows us to play across channels. It's a category that will have a strong play in dine-in and takeaway, also in delivery. Chicken is a food that, like pizzas, travels and holds up well in delivery. And we believe that, therefore, Popeyes will also be an omni-channel business with a strong delivery bias. It will also be a digital-driven brand, as all the young brands now. We intend to open our first store in this financial year. And, of course, we intend to scale up the network progressively over the next few years. We have an agreement with Popeyes for a certain number of stores and a commitment for a certain number of stores. But from our Domino's experience that ends up being the minimum threshold. We end up exceeding. We are aggressive about store expansion, and therefore that number ends up being just a notional number. So we will be building the network out aggressively after proving the model and making sure that we have the right store level economics established on Popeyes. So
sure.
That's your first question. On the margins, Latika, as you know, in this quarter, we had a slight impact on food costs. The food cost increased sequentially versus last quarter, and this was the impact of inflation on our cheese prices versus quarter 3. We also saw an increase in edible oil prices, although the impact of that was much lower. So there was impact on the food cost of these 2 inflationary items, mitigated partly by a reduction in wastage. As we look forward, we believe that between potential inflationary headwinds that we might see and our own mitigation plans, we do not expect a big headwind on food costs or indeed on inflation in the year ahead.
Sure. And do you think on an EBITDA margin level, do you see a scope for a big drag from the new investments you're doing? I don't know how you aggressively go on the other formats for the next 2-3 years, but.
Okay, so your question, Latika, was about drag on EBITDA margins, and I lost you after that. Please say that again, please.
Yeah, so my question was on the EBITDA margins. These have moved up nicely over the recent years, right? You basically ended the year with almost close to 23.5% EBITDA margins. So I was just wondering, with such an aggressive, store expansion plan for Domino's and the new investments you're doing, how do you see the overall EBITDA margins moving ahead? Do you see a space for any improvement? Yeah.
Yeah, no, thank you. I'm sorry I couldn't hear you earlier properly. But to answer your question very, very clearly and unambiguously, while we are looking at an aggressive expansion of our network, you've seen that our margins over the last 3 years have held up and improved, if anything, despite the fact that we haven't taken any price increases and despite the fact that we've gone back to rapid network expansion. Going forward as well, we do not expect a growth in our store network or indeed the expansion of our portfolio to other brands to lead to margin dilution.
Thank you so much, Pratik, and all the best.
Thank you.
Thank you. The next question is from the line of Ashish Rai from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Am I audible?
Yes, please.
Yes, sir, you are.
Yeah. Prateek, just on the expansion opportunity and the plans, your comments mention about driving hyper growth through innovation and portfolio innovation. So, I mean, you did comment on stepping up the expansion plans, but could you give any indication for next year's plans for Domino's and the other formats?
So, actually, like I said in the response to an earlier question, we are focused on driving network both on Domino's and other stores, other brands aggressively. We believe that post-COVID, the category structure will fundamentally change, which will allow the organized sector to grow faster. We allow for a bigger brand play to be even higher. The consumers will navigate towards trusted, credible, safe brands. The category will become truly omni-channel. Delivery will become a much larger part of the mix, even in smaller towns. Digital channels will stay large. All of these are areas where we have a significant strength. So we expect growth to be strong in the years to come, both for the category and for our business. Towards that, we'll be expanding our network. Unfortunately, given where we are right now in the environment, where there are operational on-ground controls and restrictions and constraints in the pace of expansion, we are not able to give a specific commitment on the number of stores right now. But like I said, we'll be at least opening as many stores as what we opened last year and aiming for a higher number, subject to on-ground conditions permitting.
Got it. And could you also give out what's the minimum store opening target for Popeye over the next 3-5 years, whatever's there in the agreement?
No, Ashish, like I said, we obviously have an agreement with Popeye, but those numbers are more the minimum threshold. We're going for a much more aggressive number on Popeye because we believe in the potential of this category. So no specific number to share as of now.
Oh, okay. One last small question is if you can indicate if there are any price hikes you have taken or any change in delivery charges that one may look at.
No, there have been no changes in delivery charges or indeed any price hikes in the last quarter.
Okay. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Rahul Arora from Nirmal Bang. Please go ahead.
Thanks, Prateek and team. Just wanted to get a slightly medium-term outlook, Prateek. Say if you're looking out 5 years from now on the company, what percentage of your revenues roughly would be non-pizza?
I'm sorry, what outlook did you give? How many years? I'm sorry, your voice is breaking.
If you're looking out, say 3 to 5 years, what percentage of your revenues would be non-pizza? Now that we're diversifying into other aspects, what would these contribute to a percentage of our revenues 3 to 5 years from now?
No, got your question now. I think the exciting part about our business is that we see headroom for growth across all our brands, across all our portfolio brands. Whether it is Domino's in India or indeed it is a new brand which obviously have a very low base and therefore will see aggressive growth in the years to come, or if it is the Popeyes business, or indeed the Chef Boss range, or our international markets, Bangladesh and Sri Lanka. All of these businesses have an exciting potential for growth. And we intend to invest in growing these, like I said earlier, in a calibrated way and in the pursuit of what we believe is a hyper growth opportunity. That said, it would be hard for us to put a number to how the mix will change. Domino's will obviously remain a large part of our business, but we will see the new businesses acquire critical mass and scale over the next 3 years.
And you would look to leverage digital in a material way for them as well as you are doing for your pizzas right now, I assume.
Absolutely. So we have 2 foundational capabilities that we leverage across all brands. One of them is supply chain, where we will be using a supply chain strength and a commissary network to support our new brands and allow them to grow faster and to scale up faster. And the other one is digital, like you asked, where our digital capabilities will support all our new businesses.
Fair enough. Just one quick one. While it might be early days yet, Prateek, would you be able to just sort of throw some light on how profitable the new ventures are vis-a-vis the core pizza profitability? Say the Chinese or the biryani, if you were to compare them at a gross or EBITDA margin level, how do you see the profitability scaling up vis-a-vis the pizza business? Are they pretty much in line, more profitable? And do you see beverages playing a major role for you going forward in any way? Thanks.
Thanks, Ashish. I think if I may reframe the question a little bit, it would be an unfair comparison because given the scale difference between Domino's and the other brands, and given the vintage experience that we have for Domino's and the new brands. So let me reframe the question to say that do we see the margin profile for these new brands being any different from Domino's? The answer is no. I think structurally speaking, all our new brands, whether it is Popeye potentially, or indeed Hong's and Ekdum, which we already seen on the ground, we see them absolutely having a similar margin profile to Domino's.
And would you be looking at beverages in any way, Prateek, as a push going forward?
Absolutely. Beverages remain an important part of our product mix. And both in delivery and in dining, you will see us growing and investing in beverages going forward.
Stay safe. Thank you so much, Prateek. Appreciate it.
Thank you.
Thank you. The next question is from the line of Sunita Sachdev from UBS Securities. Please go ahead.
Yeah, hi Prateek. Good evening. Just as you shared a little while ago, the chicken market sizing opportunity, could you also share with us the size and growth that you've seen in the pizza market over the last 5-6 years?
Sure, Sunita. Thank you for your question, and I hope you've been well. Yes, we see, as I mentioned earlier, a large opportunity for the chicken market. In the pizza category as well, we have grown the category and we've grown our market share in the last 3 years, and we expect that trend to continue going forward. We have retained a large share of the pizza market over the last 4 years. Despite the growth and arrival of many more competitors, despite the addition of many new players across the country, and despite the growth of delivery led by aggregators in the pizza market. So our market share has grown, our revenues have grown, and we've grown the category as well. And we expect that to continue going forward.
No. My question was in terms of market size. You shared the chicken market is 4,000 crores. How big is the pizza size opportunity in India? And if you could break that up into volume versus pricing in terms of what has happened in the last 5-6 years.
So Sunita, if you look at the pizza market size, our revenues and our market share 70%, we give you the total market size. Okay. And if you look at your other question about volume versus ticket, I think the really encouraging part about the last 3 years' performance has been the fact that our growth has come on the back of expansion in orders, expansion in customers, and growth of frequency as well. Our pricing, as you know, has been just not there. We haven't taken pricing in the last 3 years, except for a very small correction that we made. So there has been no pricing that we've taken, and our growth has been fueled by orders, fueled by delivery within that, and within that by our own assets. So the business has fundamentally become structurally better over the last 3 years, and we've grown on the back of order count and new customer acquisition. As market leaders, Sunita, we are cognizant of our responsibility of growing the category and not scrapping just for market share. And in the last 3 years, I think what's worked well for us is that we've helped grow the category growth.
Sure. My second question is on delivery. I mean, I know there is now it's going to be in the base. Delivery obviously gets charged, to revenue. So it obviously has a level of, a job of inflating to some extent the same-store sales growth. So going forward, what really is your outlook for same-store sales growth, given that the 3-4 percentage points will be lower, given that delivery will be in the base?
So Sunita, you're right. I think starting next month onwards, we start seeing delivery charges come in our base. But our growth will be driven on the back of order growth coming back. If you look at our comments for last quarter, we were happy to see order growth come back in quarter 4 after the first 3 quarters where our recovery was driven more by the ticket and the bill value. We were happy to see a recovery of orders in Q4 at an aggregate level. So as we look ahead, we see growth continuing on delivery, strong growth on delivery. We see strong growth continuing on takeaway, and we see the dine-in channel come back. Dine-in plays to a very important occasion of socializing, of people getting together and celebrating, and we believe that once the immediate concerns on COVID abate, when vaccination is done at scale, dine-in will come back. So going forward, we see delivery and takeaway consumption holding up, and the dine-in recovery giving us that impetus to overall order count. And therefore, we expect orders and order growth to drive our revenue going forward.
All right, that's a really optimistic outlook. Thank you for that. Just a small comment on the side. I know this is not a question. You guys do give us, app downloads every quarter. The number of app downloads every quarter. But I noticed, your investee company in Eurasia provides a percentage of revenue that comes from their own apps. It would be nice if you could also provide percentage of deliveries or percentage of order value coming in from your own apps. That will be really helpful. Thank you.
No, thank you for the feedback, Sunita. We will evaluate it. Thank you.
Thank you. The next question is from the line of Tejas Shah from Star Capital. Please go ahead.
Hi, Pratik and team. Thanks for the opportunity. My question also pertains to app first. So the lifetime addition that we would have done on apps till last March, we have actually added 70% of that user this year itself. So what is your read on this momentum? Is it more pandemic-led, or you are seeing any structural change in the momentum here? And second adjacent question here is that what is the profile of the app-using customer? Is he or she much more profitable than a non-app user's customer of ours?
No, thank you, Tejas. Thank you for the question. On your first question on app downloads and on the app, the expansion of our app install base, I think that has been an outcome of a very clear and a very concerted strategy of driving our own assets disproportionately. We have increased our investments on digital marketing and performance marketing over the last 1 year. And while we had that going even earlier, post-COVID, we increased that significantly. We, in fact, doubled our performance marketing spend last year versus the previous year. Number one. Number two, we've ensured that the most attractive offers for our customers are on our own app. So if a customer is looking for the best possible offer, we'll get that on our own app and not on any other platform. Number three, for a customer who's a medium or a high frequency customer of Domino's, the most intuitive and the most seamless customer experience actually comes on our own app. It's much faster. The number of steps to ordering are much lower. The friction is much lower, and that has led to a much larger segment of our high frequency and medium frequency customers ordering from our own app versus aggregators. So this is the second part of your question. Our own asset customers and own app customers are higher frequency customers. They stay with us longer. They have a higher ticket size than aggregator customers, and therefore they have a much larger lifetime value than others. So our most valuable customers engage with us through our own assets.
Sure. Second and last question is, owing to pandemic last year, now we are seeing many earlier dining only formats have also developed capabilities of deliveries in the last 12 months. And now we are hearing that even NRAI is planning to launch its own food delivery app. So post-pandemic in a normalized world, how do you see competitive landscape just on delivery part versus pre-pandemic era?
I think clearly post-pandemic, the delivery market has grown faster. And I think through the course of last year, most restaurants realized that delivery as habit was here to stay. Of course, our category in our business, we've known that for the longest time now. But for many other categories, including casual dining, etc., I think the penny drop movement came towards the second half of last year. And I think everybody realized that this was a fundamental consumer behavior change. So even as dining would resume over time, delivery was here to stay, and which is why a lot of brands are investing in driving their own assets and own the digital stack. In our case, of course, you're aware that we've been investing in digital for many years now, and that's been a big reason for our success. I think what will drive delivery, what's always driven delivery, has been ease of ordering and a smooth end-to-end customer experience. Given the fact that we have our own digital assets and we also have our own last-mile delivery system that we control, we believe that we provide the best delivery experience to our customers. And delivery will remain, has always been, and will remain a source of competitive advantage for us.
This is very helpful. Thanks and all the best. That's all from my side.
Thank you. The next question is from the line of Prasad Deshmukh from Bank of America. Please go ahead.
Hi, Pratik. So two questions. Firstly, now that you are scaling up in three new categories, three new brands rather, what will be the new organizational structure? Looks like you guys are appointing a chief business officer, so officers for each one of them. So just wanted to understand what the new structure will look like.
In the new structure, we have the chief business officer for Domino's India reporting into me. The head of operations and the head of marketing report into the chief business officer of Domino's India. Other than that, there is no structural change. The business heads for the new brands, for Popeyes and for international, and indeed the other functional heads reporting to me, as they have been doing in the past as well.
Got it. And second question is on operational synergies. So in terms of these two brands being added to the portfolio, that is Ekdum and Popeye, what kind of sharing of resources is possible when they are scaled up, especially from, say, sourcing perspective and the store operations perspective?
So yes, I think one of the advantages that we have as Jubilant Foodworks is that we have some very basic foundational capabilities that we've developed over time on Domino's, and which we can replicate to support the new brands as well. Clearly, supply chain is one area where our sourcing capabilities, our manufacturing and central kitchen capabilities, our vendor partnership that we've forged over the years, all of these will become big sources of strength for the new brands. Will of course be new partnerships that we will tie up, and new learning that we will have. But the foundation of our supply chain will be something that will work well for a new brand. Number one. Number two, the fact that we have now over the years built a very strong digital backbone with a very strong digital team and growing digital capabilities. These capabilities will also be used to support all our new brands. And again, that's an area where our legacy strength in Domino's can support growth and customer experience in our new brands. Number two. Number three, the capabilities that we've acquired in Domino's of hiring talent at scale in our stores, deploying talent at scale, training them, supervising them, growing them and grooming them. Again, that capability is something that we will replicate in the new brands. That said, we also have to grow and acquire new capabilities, learn about new categories, learn about innovation in these categories. And that we will do, and we are doing, by investing in building dedicated teams for these new businesses. So the new brands going forward and new businesses will be a great combination of dedicated focused teams which have only that brand remit on their agenda, supported by cross-functional teams and help replicate best practices from other brands and from Domino's.
So just to clarify, so these are also commissary-driven brands?
That's right.
Okay.
They will grow over time to be commissary-driven brands, absolutely.
Okay, thanks.
Thank you. The next question is from the line of Jay Kumar Doshi from Kotak Securities. Please go ahead.
Hi, thanks for the opportunity. My first question is, could you please share your thoughts on pricing lever? We've not taken any price increase in the past 3 years other than the introduction of delivery charges. And so how should we think of it from the next 3-year perspective? Are you more open to take price increase irrespective of how RM price environment is? And because when we benchmark Domino's prices versus other pizza brands, especially on the delivery platforms, there is a significant gap, Domino's is at a decent value to competition today. So if you could share your thoughts on pricing lever.
So, Jaykumar, so thank you for your question. And your observation is accurate and spot on. That over the last few years, we've been very, we haven't taken price increase. And today, our prices are lower and advantage from a consumer point of view vis-a-vis most other brands in the category. We believe that by not taking pricing and challenging ourselves to take costs out to drive margins has made our business model stronger, more robust, and more future ready. That's the first point. The second point is that in the post-COVID area, where the discretionary incomes have been challenged and will be challenged, we know that we'll be facing an extremely value for money conscious consumer. In any case, Indians are driven by value for money and they're very price conscious. And we believe that going forward as well, if anything, that expectation will increase. That said, we recognize that we have headroom in pricing and we have a gap vis-a-vis competition. So as and when the need arises, if inflationary headwinds come our way, or if we believe there's an opportunity, pricing has been and will always remain a valid lever for us to drive revenue.
Thank you. I have one more question. You mentioned a couple of occasions that you can leverage the digital capabilities of Domino's to replicate and support the new brands. So are there any restrictions from Domino's end? Can you use the same platform, same framework that you're using for Domino's app for other brands as well? Or, there will be some thoughts there?
So, Jaykumar, I think what I meant when I said lift and shift best practices is about using our knowledge of technology, which is not brand specific, which is a platform knowledge about technology, about the customer experience, about the UI, UX. Use those learnings and similar learnings on supply chain side to drive our new brand. Domino's will be evolved up completely from a user experience point of view and an asset point of view, but the learnings will be used to drive our growth in the new brand.
Understood. Thank you so much.
Mr. Doshi, does that answer your question?
Yes, please. Thank you so much. That's all.
Thank you. The next question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good evening, Pratik and team. My first question is on volumes. You indicated that in 4Q you saw some volume growth. So would this be sort of overall volume growth for the total number of pizzas sold? Any sense you can give us on that?
Aditya, your question was about volume. Is that right?
That's correct. So, you indicated that you returned back to volume growth. So would this be sort of overall volume growth? Because, if I do if I think of the math, obviously, if once we remove the delivery fee, it doesn't seem to suggest a huge amount of volume growth.
So, Aditya, the volume that I was referring to was to order volume growth. So we grew in orders vis-a-vis same time last year in quarter 4.
I understand. That's very clear. Secondly, in terms of, you just answered the previous question, but can you have a super app of sorts, where you can, on a single app, have all your brands, or that's not possible?
So, Aditya, I think our focus right now remains on driving a strong set of digital assets for Domino's and for each of our new brands individually. And that is a primary focus because each of these brands are distinctive, unique brands.
with different customer franchises, and we intend to therefore make sure that they have strong assets by themselves. Potentially, it can be a super app. Hypothetically, I guess we could, but as of now, our focus is on developing our own assets individually for these brands, because they are different segments with different customer cohorts, and we have to make sure that we are relevant for each one of those separately.
And the footprint is completely different, and the footprint of the brand is very much different right now.
Yes, no, I understand that fully. I mean, I'm just thinking from, let's say, 5 years out, when some of these are sizable, could you have some sort of a super app? But I think your answer sort of clarifies that. Thanks a lot. That's it from my end.
Thank you, Aditya.
Thank you. The next question is from the line of Karan Tarani from Elara Capital. Please go ahead.
Hi. Thanks for taking my question. So my first question is, in terms of any kind of risk you believe are there in the new business initiatives, specifically with Hong's Kitchen and Ekdum Biryani, given the kind of product they are, right, in terms of standardization and the kind of ingredients, sauces, everything put together. So any kind of risk you can highlight there, and how do you plan to mitigate them?
So, Karan, your question was about any kind of risk, did you say?
Yeah, any kind of risk in terms of business execution or in terms of scale for these businesses, and how do you plan to mitigate the same?
Got it. No, so thank you, Karan. As you said, each of these brands have a unique set of challenges. They have a different set of products, different processes, different set of vendors in some cases, and differential challenges in terms of standardization and ensuring consistency. Our teams are working on making sure that we have these processes put down and ironed out, and we're happy to see the progress we've made already in Hong's Kitchen and more recently in Ekdum. Despite the fact that we don't have a standard set of guidelines to follow like we do, for example, in Domino's, I think the team has made encouraging progress in putting down those SOPs, refining them, making sure that we're able to give a consistent experience to our customers. So, do we see a risk there? No, we do not see a risk, but that's definitely a work stream that is a new one for us, and that's what we're working on.
Right, thanks. And the second question would be in terms of trend reversal. Of course, this year you did see outperformance versus industry because of your exposure to delivery, right? Now probably say whenever unlock happens in a big way, footfalls come back in malls, high street put together. Do you expect maybe 2 or 3 quarters of underperformance because of the shift towards the players which are heavy in terms of dine-in? That's one. And within that also, what about the share in terms of this organized players gaining? Do you believe that is sustainable over medium to long term as well, or these are just COVID trends and again the numbers will basically come back favorably for the smaller and the other players as well?
So, Karan, actually, I would see this a little differently, your question. I think if you look at our May performance, which we called out in our release, despite the fact that dining was pretty much shut completely, despite the fact that there were strong mobility restrictions which impacted the takeaway channel, we have delivered an 88% recovery, which tells us the amount of slack that delivery has picked up by itself. Number one. Number two, we are seeing dine-in restrictions getting slowly revoked. And as the sentiment improves, as people get vaccinated, you will see the dine-in channels start coming back. That, if anything, will give an incremental tailwind to our revenues rather than take away from our overall recovery. Like I said earlier, dine-in plays to a different occasion compared to delivery. And as dine-in restrictions are removed, we will see that come back, see the channel come back in the future. Indeed, if you look at the last quarter 4, you saw the dine-in recovery play out very clearly. We had a strong recovery in quarter 4 at 64%. And double click on that, March was even stronger. So our data in the past has shown us that when supply constraints are revoked and are removed, the demand comes back. And we expect the same trend to play out in the future. And that's what gives us excitement. We believe strongly that the delivery habit that's been adopted in many new towns and town classes by customers, for the larger part, that delivery habit will endure. And as dining restrictions go away, we should see dining come back as well. And that gives us confidence that we will see strong growth in the future. Number one. Number two, on your question around the organized brand share, I think it's a very fundamental trend that we are seeing and that we have seen for the last 1 year across multiple categories, not just in food service, that the bigger brands are getting preferred and are gaining in share as a result, because consumers want the conviction and the certainty and the safety of brands with quality standards, making standards they can take almost as dead. So that trend will continue, and we will see strong brands, big brands, credible brands have greater momentum. We don't expect that to reverse.
Yeah, but just an exponential gain this year because of COVID, because clearly standalone restaurants, smaller chains have scaled down. They still remain to be shut. I mean, the entire, about still 20% of the restaurants in the ecosystem or even more still remain to be shut. So just trying to get that, this exponential share which you've gained this year or maybe in the last 6 months for the organized players, is that kind of sustainable, or, you could see some trend pattern reversing on that as well?
No, we do not expect to see the situation normalizing in any way impacting our market share. I do not think so at all. We are actually very excited by the growth prospects that lie ahead, and we don't expect to see any impact on market share. Quite the contrary.
Right. So on a steady state, of course, the market share gains would be there, but maybe you have a year wherein because of the exponential gain, in 1 year, in that particular year, say probably, FY22 or second half of FY21, that gain would not be as compared to pre-COVID, just because the other restaurants are opening up and the competitive intensity increases. Something of that sort. I mean, that's not expected from organized players.
So Karan, again, I will repeat what I said, which is that we do not expect the situation being normalized leading to any adverse impact for us. Not at all.
Pratik, if I can add, this is Hari Bhartiya. What we saw during pandemic is even in the small towns, the habit of delivery has been consistently growing. Now, delivery, once it grows and once people become habitual to delivery, even in smaller second and third tier towns, it tends to stay. It's sticky. Tends to stay. It doesn't go back to the original level fully. That's what we believe. So I think the post-COVID environment has actually, during the COVID, we had opportunity to show our delivery prowess to customers who were mostly coming to the stores to experience dining. So I think to us, we believe it opens up more opportunities. People who were not digital, were not ordering digitally, started ordering digitally in the smaller cities also. So I think it's a good habit. Today we see, Pratik can tell you, we have almost everything coming digitally to us. All orders, almost 95%. Pratik, if I'm correct.
That's 98%, absolutely.
98%, yeah. So I think post-COVID environment is only giving us more opportunities.
Right. Thanks. That's from my side.
Thank you. Ladies and gentlemen, we take the last question from the line of Sheila Rathi from Morgan Stanley. Please go ahead.
Yes, thank you. Hi, Pratik, and thank you, Mr. Bhartiya, for making the comment to the last question. Just a question there. Do you think going ahead, from a strategy point of view, you believe that the new store additions will be more in newer cities, because that's where you think that the tailwind will be there? I mean, my question is that on an incremental basis, do you think that new cities will be the big driver of the growth for Domino's?
No, thank you for the question, Sheila. I think the really encouraging and exciting part of the Domino's opportunity that we see ahead of us is that we see ample headroom to grow our store network, both in existing towns and in new towns. Let me give an example of Bangalore, just to illustrate the point. 3 years ago, we had less than 100 stores. And as we speak today, we have more than 150 stores in Bangalore. And Bangalore is one of the fastest growing markets for us. We see the same opportunity for us in every market after market. Whether it is Delhi, NCR, or a Mumbai, or a Kolkata, or a Hyderabad, or a Chennai, I could go on. We see a lot of headroom for growing our store network in all of these markets, in coming closer to our customers, in coming closer to our communities, reducing drive time, improving speed of delivery. So that's a big opportunity for us. Equally, like you said, we also see opportunity in opening stores in towns where we don't have a presence right now. So, for example, we have a presence in 293 towns. There are almost 700 towns in this country with a population of more than 1 lakh. So clearly, we see headroom for us to grow the network, to expand the network by entering many of these towns. And that's what makes our growth prospects so exciting. That we have almost, so to speak, a problem of plenty. We have opportunities to expand both in new towns, in new channels, and in new towns and existing towns.
Thank you.
Thank you, Sheila.
Thank you.
To the moderator, I just have one request. We had in the beginning, yes, Vivek Maheshwari, whom we couldn't hear. If Vivek is there, we could take one last question.
Let me just check. Allow me a minute, please. Sir, Mr. Vivek Maheshwari is disconnected.
Okay, not a problem. Thank you. Thank you for checking.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for their closing remarks.
Thank you. And thank you, everyone. We appreciate the time that you spent interacting with us today. I hope that we've addressed all your questions and queries comprehensively. And if you have any unanswered questions or any areas where you have a clarification that we need to provide, please get in touch with the IR team, and we'll be happy to engage and to clear those doubts. Thank you so much. Stay safe and good evening.
Thank you. On behalf of Jubilant Foodworks, this concludes this conference. Thank you all for joining. You may now disconnect your line.